Welcome to the deep dive. We are jumping straight in today with the Q3 2025 results from Bullish, and they posted some genuinely record-breaking metrics.
That really is the headline, isn't it? Record-adjusted revenue, record-adjusted EBITDA, and, I think crucially, record-adjusted net income. These are the figures that tell the real story here.
Right, a story about a big business model transformation. So let's get into the specifics behind those numbers.
Let's do it.
Okay, so unpacking the core financials for Q3. Management said the results were in line or above guided ranges.
And looking at the year-over-year growth, the scale is it's significant. This isn't just a little bit of improvement.
No, not at all. It's a huge shift. So the top line, adjusted revenue, where did that land?
It reached $76.5 million. And for context, that's a 72% increase compared to the $44.6 million they reported in Q3 of 24.
And you can see that leverage so clearly on the bottom line. Adjusted EBITDA just soared.
It really did, up to $28.6 million.
We're talking about a 271% jump year over year from just, what, $7.7 million?
Exactly. And for investors, the metric that really signals health is that adjusted net income. It came in at $13.8 million.
Which is a complete turnaround.
A powerful reversal from the $3.1 million loss they saw in the same quarter last year.
And it's worth pointing out, even the strict IFRS net income looked good.
It did. That's the standard accounting measure. That was $18.5 million, up from a massive $67 million loss the year before.
So this isn't just adjusted profitability. It's fundamentally profitable, whichever way you look at it.
Right.
But the real deep dive here, it isn't just that they grew, it's how. It speaks directly to a very deliberate strategy.
Absolutely, because, the traditional view of a crypto exchange is, it's volatile. High trading volume, high revenue. Low volume, low revenue.
And Bullish is actively trying to get away from that.
They're migrating away from that model.
Yeah.
And the proof is right there in the composition of this record revenue.
You're talking about the subscription services and other segment, the SS&O revenue.
Precisely. This non-transactional revenue was the massive driver. It hit nearly $49.8 million, a new record.
Wow.
And to put that in perspective for you, that's over 300% growth year over year.
Yeah.
Just think about that. It was only $11.5 million in Q3 2024.
That is just explosive. And what's really significant is the proportion of the business it represents now.
Well, if you zoom out and look at the whole year to date, SS&O now makes up 53% of their total adjusted revenue.
So it's a majority now.
It's the majority. They went from a company where services were, 28% of revenue for all of 2024 to a company where stable, recurring services are the main thing.
It's like they're selling the shovels instead of just mining for gold.
That analogy hits the nail on the head. Because the transaction side of the business, the trading fees, that didn't drive the record.
No, adjusted transaction revenue was actually down year over year.
Right. It was $26.7 million compared to almost $33 million last year.
Yeah.
The services business is more than making up for it. It's taking over.
And what's fascinating to me is that they pulled this off while getting more efficient.
They did. They achieved this massive shift while keeping a really tight grip on costs. Adjusted operating expenses actually decreased by 2% just from last quarter.
Down to $47.9 million. And that was driven by some really targeted, aggressive cuts.
Yeah, advertising spend, for example, it dropped from over $7 million to just over $1 million. Quarter over quarter.
Plus some smaller reductions in legal and professional fees.
That scale of ad reduction, it does raise an interesting question. I mean, is that level of efficiency sustainable? It definitely boosts EBITDA now in the short term, but you have to wonder if cutting marketing that hard risks future client acquisition.
Especially for their institutional focus.
Exactly. It suggests they're relying almost entirely on their reputation and their sales teams now.
A calculated risk, I guess, betting that institutional clients don't need mass market advertising.
Well, the numbers this quarter suggest it's working.
Okay, so that strength in Q3 really sets the stage for what's next. We have to pivot to the Q4 guidance.
Right, where management is expecting, continued momentum, maybe just a little more moderate.
Specifically, they're guiding for that all-important SS&O revenue to be between $47 and $53 million.
And keeping those adjusted operating expenses tight, between $48 and $50 million.
So let's just analyze that SS&O guidance for a second. The midpoint of that range is, it's pretty flat compared to the record Q3.
It is. And management gave a couple of reasons for that. First, seasonality. They pointed out that Q4 is the only quarter this year that has zero revenue from events.
Okay, that makes sense.
And second, some slight impacts from the broader crypto market prices, though they said that was being offset by strong contract signings for their liquidity services.
But on the other hand, the transactional side seems to be snapping back hard.
It is. The trading momentum is real, and it's driven by market conditions. Quarter-to-date volume through mid-November was already at $126 billion.
So management is expecting materially higher transaction revenue.
Right, compared to Q2 and Q3. And that links directly to, more volatility in the market and more people actively trading.
Which is funny because volatility, even if prices are falling, is actually great for the exchange business.
It drives activity, exactly.
So here's where the story gets a little weird and where our deep dive gets really interesting.
Paradox.
Yes. Despite posting these record profits, proving the business model works, and giving pretty positive guidance, the stock fell. It dropped almost 7% in pre-market trading.
Right, down to $36.26. This is the paradox you have to wrestle with. Why the dip when the fundamentals look so strong?
So what's the thinking? Profit-taking.
That's probably part of it. Straightforward profit-taking after a run-up into the report.
But there's a more nuanced take, too, right? It's about expectations.
I think so. The stock was already trading near its 52-week low, which tells you there's some investor caution baked in.
So when a company posts a record quarter,
investors often expect the guidance to predict an acceleration of that growth. The fact that the SS&O guidance was basically flat, even with good explanations, well, it may have disappointed some people.
So the market is saying, great quarter, but show us exponential growth in Q4 or we're pulling back.
It's the classic expectation trap. They delivered, they proved the pivot works, but the market might be looking at the services guidance and just finding it a little too conservative.
It really highlights the uncertainty that's still attached to the whole crypto space.
Absolutely.
So let's move beyond the numbers and look at the actual products that are fueling this SS&O growth.
Yeah, the strategic launches. These are crucial. The full launch of crypto options in late October is just a massive proof point.
It saw explosive adoption, right?
Immediately. It quickly surpassed $1 billion in cumulative trading volume. On its peak day, it hit $240 million in volume. That's about 4% of the market share, almost overnight.
So what's the big appeal there for the institutional players? What's driving that volume?
It really comes down to their engineering. They use a single matching engine for everything, derivatives and spot.
And that allows for portfolio margining.
Exactly, portfolio margining. And for you, the listener, that basically means if you have positions that offset each other, like a long Bitcoin spot position and a short Bitcoin future, the exchange treats them together.
Which means you have to put up much less collateral, less margin.
Way less. It's all about capital efficiency. And for a big institutional fund, that is a huge competitive advantage. It makes the platform sticky.
Okay, so let's shift to the bigger long-term strategy. The CEO seems to be leaning really heavily into tokenization.
He is. He frames their liquidity services as the key to capturing, and I'm quoting here, the most transformational crypto value proposition of the next decade, tokenization.
They're building the rails for traditional assets to move onto the blockchain.
And the metrics show it's happening. Their active partner count doubled in Q3. That's over 100% growth in new partners from just the previous quarter.
So they are rapidly signing up institutions to use those rails.
Precisely. And they've broadened their blockchain relationships, adding networks like Canton, Cardano, Midnight, VeChain, building on what works.
And their work with stablecoins is kind of the blueprint for all this.
It is. They're partnered with almost every major stablecoin issuer except for USDT. And they're using that experience of tokenizing the US dollar to create a roadmap for tokenizing other assets.
And the Solana case study is a perfect example of their impact.
Oh, it's a phenomenal example. In just the first quarter of working with them, Bullish was responsible for minting over 80% of its stablecoins on the Solana network.
Wow.
And that directly contributed to a 40% plus growth in Solana's total stablecoin value locked. They're not just a processor, they are a fundamental part of the infrastructure.
And that commitment is cemented by their regulatory moves, like applying for that SEC license.
Yes, the transfer agent license.
Yeah.
That is a very strategic move. If they get it, it allows them to offer much more robust services for tokenizing U.S. securities. It bridges that gap between TradFi and the decentralized world.
So all this success, these new products, it's really the direct result of a regulatory strategy that was frankly very long and very difficult.
It was, and that was by design. It was incredibly resource intensive.
Yeah, spending years getting tough approvals, Hong Kong, BaFin in Germany, and then finally the big one, the NY Bit license in September.
And that's what unlocked U.S. institutional spot trading for them.
But I guess the question is, didn't that long process kind of stunt their growth compared to the competition?
It's a fair challenge. They paid a high cost in time and money, but the payoff is immediate liquidity.
Right. They thought institutional onboarding would be slow, but it's happening much faster.
Way faster.
Yeah.
They've already brought on marquee clients. We're talking big retail brokers like Webull and Moomoo, institutional powerhouses like Cantor Fitzgerald.
And a major crypto custodian.
So the CEO's insight was brilliant. Get the tough licenses first, and you can launch in the U.S. with an already established global order book. No cold start problem. It's a massive competitive moat.
And we shouldn't forget the information services side of this. CoinDesk, that's a huge part of the SS&O segment.
Hugely strategic and very lucrative. CoinDesk indices assets under management grew to $49 billion. That's up from $41 billion in Q2.
And here's a stunning fact.
Go on.
Since their last earnings call, 5 of the 6 SBOT crypto ETPs launched in the U.S. were based on a CoinDesk index.
Which means they are the pricing authority for a huge slice of the institutional crypto investment world.
And the media side just feeds that whole ecosystem. It creates its own demand.
Yeah, CoinDesk.com is still the top crypto news site. And their subscription service, CoinDesk Research, acts as a natural upsell for their liquidity clients. It's a perfect land and expand model.
Okay, finally, we have to touch on the internal dynamics around Bitcoin volatility. It's a bit of a cross-current for them.
It's a double-edged sword, for sure. They hold about 25,000 Bitcoin on their balance sheet.
So they're highly exposed.
Very. Lower prices mean their balance sheet takes a hit. But, as we said, high volatility is the engine for their transaction revenue.
And for their media site, too, interestingly.
Right. Web views actually spike when Bitcoin starts falling because everyone is looking for answers. If it stays down, traffic drops off. But that initial shock is a viewership boost. It highlights the balance they're trying to strike.
So what's the big takeaway here for you, the learner tracking this sector? To me, it's unambiguous. Bullish is successfully executing its strategy.
They're moving away from relying on volatile trading fees.
And the record profitability this quarter was structurally driven by that SS&O growth and by successful new launches like options. The diversification is working.
And if you connect this to the biggest picture, the political one, you have to watch the CEO's involvement in D.C. They're talking about a broader market structure bill.
A huge potential catalyst.
The biggest. If Congress passes a bill that provides real legal certainty for digital assets, it could unlock a flood of institutional money into the market.
And that would dramatically accelerate the next phase of tokenization. U.S. stocks, fixed income.
All the things Bullish is already perfectly positioned to capitalize on with its strategy.
So you absolutely have to keep tracking those SS&O revenue streams. That's the metric. That shift in the business model is what validates these results.
Right. Regardless of the market's initial kind of skeptical reaction to the guidance, the success of the service business is the foundational knowledge you need from this. If institutional rails are the future of crypto, well, they've already built the engine.
The only question left is, how fast will Congress let them drive?